Good afternoon. Good afternoon. It's Monday, the 21st of April. Welcome to another edition of Monday Market Picks. I'm Thilan Wickramasinghe, the head of research for Maybank Securities here in Singapore. The clouds shrouding the global economy are going to take some while to clear. The deal-making phase of the Trump tariffs are ongoing, but the outcomes again are very, very unclear at this stage. Plus, we're entering a pretty data-heavy week with a lot of regional central banks looking to cut rates. Plus, we are waiting to see what US consumer sentiment and inflation looks like towards the end of the week as well. So times like this, you need a defensive shield. And that's what we're going to be focusing today on our show. So REITs are a major sector to look at going forward. So we're talking to Krishna Guha on his latest views on the S-REITs and why he's keeping his positive ratings on the sector. Then we go across the causeway to speak to Noor Sifa on why she is positive on the M-REITs. We speak to economist Brian Lee on Singapore's latest export numbers, as well as and what that means for growth. We also have Husseini joining us to talk to us about Singtel. It's actually held up pretty well. And so we're going to speak to him about what he thinks is in store going forward. Plus, we've got two new ideas from our chart guy as well. So let's dive straight in and let's start with economics and with Brian. Brian, welcome to the show. Now, Singapore's exports grew at a slower pace in March compared to February. What's actually dragging this down?
Yeah, hi Dylan, thanks for having me on the show. Yeah, so indeed, yeah, Nordex did grow at a slower pace, 5.4% in March, right, from a year ago, as compared to the 7.6% pace in February. And I think if you look at the seasonally adjusted month-on-month basis, I think sequential terms, it's a sharper decline actually, right? So it actually, Nordex shipments actually declined by 7.6% month-on-month, and this hit a 5-month low in Sing dollar terms, right? So basically, if you look at the breakdown, the main driver is actually non-electronics shipment. So non-electronics Nordex actually grew by a slower pace of 3.8% as compared to 7.7% in February. And I think that was partly due to a few factors. One of them is actually a contraction in petrochemical shipments. Electronics Nordex growth actually picked up to nearly 12% year on year as compared to 7% in February. But that was mainly due to a low base with PCs as the main driver and not enough to actually offset the slower growth in non-electronic shipments. Yeah.
Got it. So how are you thinking about exports for the rest of the year, especially in the context of the Trump tariff war? I don't think that's reflecting in the March numbers. So how do you think that's going to pan out for the rest of the year?
Yeah, so we're expecting shipments Nordex to slow further. For the full year, we're expecting Nordex growth to come in around 1%. That's the lower bound of Enterprise Singapore's 1 to 3% full year projection. In fact, Nordex risks are on the downside if the trade war intensifies. And the government has also reflected this in its latest press release, right? It says that it might have to revise down their forecast range with the evolving tariff situation. In the second half of 2025, that's where we see the impact to be the most, right? We think that export growth will likely turn negative in the second half of 2025, especially if Trump's aggressive 145% tariffs on China and also reciprocal tariffs on the rest of the world remain in place. In the second quarter, though, exports could see some reprieve amid the 90-day reciprocal tariff pause for countries other than China. We're already seeing that manufacturers in Singapore's trading partners are actually rushing orders and front-loading shipments to the US during the 90-day window. This may actually raise demand for components and intermediate inputs from Singapore. Yeah.
Got it. And have your forecast on GDP or Sing dollar changed right now? And also, I think quite importantly, what are the risks of a recession?
Yeah, so our forecasts haven't changed. We still expect full year GDP growth to come in at 2.1% in 2025. That in itself will be a significant slowdown from the above 4% pace that we saw last year. But our base case is still that there will be no recession this year, just a slowdown, right? And we think this for a few reasons, right? Number one, of course, in the second quarter, as I said, there will still be some reprieve to the outward-oriented sectors, given this temporary pause in reciprocal tariffs. And also, I think domestically, there are, I mean, okay, back to external again. I think that given that, it seems like the main target is still China, tariffs on China are much higher than the rest of the world. There could still be some potential for rerouting of trade flows that could actually benefit the ASEAN region and Singapore. And domestically, we have a construction boom, construction of, Changi Airport T5, Marina Bay Sands expansion, and so on and so forth. And also easing monetary conditions with MAS easing policy and also interest rates declining. We expect these factors to help, cushion the economy. And not to mention, there's also the significant firepower and significant dry powder that the government has to support the economy. Yeah.
Okay, great. Thanks, Brian, for joining us. Now let's turn to equities and talk about REITs. So just before I bring the Singapore REITs in, let's go across the causeway and talk about Malaysian REITs. And I've got Sifa on the line. Welcome to the show, Sifa.
Hi, thank you, Dylan.
Hi. Now, Sifa, despite the tariff-led uncertainty, you're keeping the MREITs outlook as positive. What's driving your conviction?
Yes, we are maintaining a positive view because the sector remains fundamentally resilient. REITs are largely insulated from direct tariff impacts, and many have stable recurring income backed by long-term leases. Their defensive nature combined with strong asset quality and stable cash flows makes them attractive in uncertain macro conditions. In fact, market volatility tends to enhance the appeal of REITs as reliable yield plays.
Got it. So reliability, clarity in terms of earnings, especially in this sort of volatile markets. But what are some of the catalysts we should be looking for in this sector?
So a key near-term catalyst would be a potential OPR cut by Bank Negara Malaysia, which would reduce borrowing costs and support DPU growth, particularly for REITs with floating rate debt. Currently, our sector averaging about 50% of sector borrowings are under floating rate debt. Other catalysts will include continued recovery in tourism and retail footfall, especially for prime malls and asset acquisitions that can drive earnings accretion and valuation upside.
Got it, got it. And so what are your top three picks, and what's the reasoning for that?
Our top picks are Sunway REIT, Pavilion REIT, and Axis REIT. Sunway REIT offers diversified exposure across retail, hotel, and office segments with strong sponsor backing and quality assets like Sunway Pyramid Mall. Pavilion REIT benefits from premium retail positioning with resilient footfall and tenant demand, especially at Pavilion KL. Axis REIT stands out for its focus on industrial and logistic assets, which continue to see structural demand tailwinds. Its proactive asset management and pipeline of acquisition support steady earnings and DPU growth.
Okay, okay. And, we can't ignore how uncertain the world is right now and what can go wrong with this call. What are the risks that you're baking in?
Okay, main risks include slower than expected consumer spending, which could impact retail REITs, particularly those with luxury exposure. Higher operating costs such as utilities and maintenance may also pressure margins. From a financial standpoint, unexpected rate hikes would affect REITs with floating rate debt. Meanwhile, for industrial REITs like Axis, supply-demand imbalances or tenant concentration risk would also worth monitoring.
Okay, that's great, Sifa. Thanks for joining us.
Thank you.
Okay, with that, let's come back to Singapore and let's get Krishna on the line. Now, Krishna, before we go on to your positive call, you ran some stress tests on the S-REITs looking back at the global financial crisis. Remind us how the sector fared during that time and what was the impact?
Yeah, thank you, Talan. Thank you for having me once again. Quite bad, actually, given that the sector has a sort of defensive branding. So if you look at the GFC period, then at the sector level, we are seeing the spot rents declining by anything between 10 to 30%. And the asset prices going down by about mid-teens percentage point. So it was that bad. And then if you are looking at the individual REIT level, then at individual REIT counters, because of the balance sheet cleansing that happened that period in time, the distribution dividend per share, NAV, that went down anything from mid-teens to almost cut by half during that period. So it was definitely quite bad.
Got it. So taking that into consideration, how has your assumptions and ratings changed?
Yeah. So, and then given this kind of current period that we are in, which is the global uncertainty that we are facing, and the GFC template that we just discussed, we, as an out of abundance of caution, we are taking a bit more cautious stance on our estimates. So we are lowering dividend estimates by an average of about 5%. And this is led by about 10% decline in top line and to some extent offset from the lowering of the borrowing costs. And then we are taking a bit more cautious stance on the more geared names. So we are using a higher discount rate for the geared names. So all in, we are downgrading 6 names, which are a bit more on the higher gearing side or exposed to the hotel side of things, which is least preferred subsector. So the 6 names are Lend-Lease, Global Commercial REIT, OUV Commercial Trust, ESR REIT, AIMS APAC REIT, and within the hospitality names, CDL Hospitality Trust and Far East Hospitality Trusts. So these 6 we are downgrading to hold, and we are upgrading Mapletree Pan Asia Commercial Trust to buy on back of the reasonable valuation. It is a large cap index names giving you about 7% yield and trading at about 40% discount to book. So that's the broad changes that we have made to our fundamental estimates and the ratings.
Okay. Now you started off saying things were quite bad during GFC, but you're still keeping a positive rating on the sector. So why is that?
Yeah, now there is a bit of a contradiction there, which I do understand. So this is on the back of the fact that we do understand that there are certain cushioning factors as well. And these are, which I mentioned right upfront, these are our own house view that yes, GDP growth has risk to the downside, but we still think that the growth will be low but positive. So we are factoring in the non-recessionary kind of a base case. Further, the SGD base rates are rapidly falling, which definitely should impact positively some of the borrowing costs. And the safe haven flows continue to come in. Plus, our macro team has also highlighted potential fiscal stimulus if the downside risks kinds of get a bit more amplified. So given that there are these cushioning factors, what we are recommending is investors to expect volatility and therefore be selective in their positioning. What we are recommending is a bit more of a large cap bias, less leverage, and more domestic focused names. And then if you are on the high yielding side, we are recommending the large cap couple of high yielders within our stock picks. So that's how we are sort of recommending and why we are maintaining a positive stance despite our kind of stress test suggesting that distribution risks are significant if the GDP growth kind of caters.
Okay. What are some of the what sort of subsectors do you think will hold up the best in the current sort of situation?
Yeah, so as I said, I think this domestic focused names. So basically, I think the retail and healthcare are the ones that we are recommending right now. And then I think we have industrial and office, the second set. And then for the least preferred is hospitality. That is how we have picked our sector preferences right now. But we'll definitely be watching the overall development quite closely to see how things can pan out. So one thing we have got a lot of feedback from investors is regarding office and hotels, which were quite badly impacted during the GFC, and what is different this time around. And on that basis, I think the office kind of stands out because we do not have that immense supply pressure that was there during the GFC. So that's something which we need to kind of keep in mind. But definitely we will be watching the overall macro development and how the subsectors are going to be positioned in the future.
Got it. I want to ask you about your top picks. Just before that, there's a question from the audience asking, what do you think about MLT results that are expected to come later this week? Any quick views?
Yeah, I think it is one stock where I have been getting hammered quite significantly, and I think the reasons are quite obvious with this whole tariff uncertainty. I think there is definitely a case to be made that there will be impact on the supply chain. But I'm taking a bit more, long-term view on this, that given that this whole supply chain shifts and people are looking at diversification, say to India and other Southeast Asian countries, I think MLT's regional warehouse footprint can become quite handy one. And given that the stock is yielding about 7+%, and if China kind of is able to spur its domestic consumption, it may not be too much of a bad risk-reward trade-off. So I am hanging in there, but admittedly, my call hasn't worked that well.
Okay, and just on calls that can work, what are your top picks?
Yeah, so top picks I have the three capital and entities, CICT and Capital and Ascendas REIT. Again, doesn't need much explanation there. A-rated credit. CICT has almost domestic presence, and CLAR has developed market exposure, no China exposure. And then CLAS, Capital and Asset Trust, which is most diversified within our hospitality names. So we are keeping that as a buy rating. And then the next set is the two Mapletree entities, Mapletree Pan Asia Commercial Trust, which just upgraded to buy, and Mapletree Logistics Trust. And the final one, bit more on the mid-cap side, is a Parkway REIT, the healthcare name, which we think will benefit from the master leased assets and also a very defensive sector positioning as well.
Got it. Krishna, thanks for that. And before we bring Hussaini in, let's have a quick look at what our chart guy has for us. He's got two trading ideas. One is NAMCHEONG. He's going to accumulate on that stock. Last Friday's gap up on strong volumes triggered a bullish crossover, and he expects that to continue. And we also have CENTURION CORP, which is something that Eric initiated a couple of weeks ago. We're quite bullish on the stock. He's got our technical view also is accumulate. The primary uptrend is poised to continue following a successful breakout from their bullish flag pattern. So a couple of stocks, you can see a lot more of that in our newsletter today. Now, let's move on to Hussaini and Singtel. This is a stock that has outperformed their ASEAN peers as well as the STI index so far this year. Hussaini, yet you're calling calling this stock a defensive shield. You've raised the target price and you're keeping your buy. What's driving this conviction?
Sure. Thanks, Thilan, and thanks for having me. So yes, Singtel has outperformed the ASEAN and ASEAN telco peers and the STI index by 23% year to date. However, its performance is in line with that of its developed market telco peers at 14%. And developed market telco peers has outperformed the MSCI World Index by 19% year to date. See, telcos have utility like of cash flows and as such are highly defensive in nature. So investors flock to those names during times of economic uncertainty. And being a developed market telco, Singtel itself the FX risk is also minimal. Moreover, Singtel operates a very strong balance sheet at around 1.6 times net debt to EBITDA, and that gives quite a bit of credence to its ability to pay 5% dividend yield. And on top of that, company has guided for a $6 billion in capital recycling, which creates potential for further capital return on top of 5% dividend yield. Operationally as well, company is very well placed, especially its Australia business Optus, where it just announced a prepaid price increase of 7 to 13%. So net, we see Singtel's cash flows and high capital return as a desirable factor during times of economic uncertainty. We reiterate our buy and raise target price on Singtel.
Right. Thanks, Hussaini, for that. Now we are running out of time, so I just want to quickly highlight some events that are coming up. Result season going to be in full swing starting this week. We've got Parkway Life REIT reporting tomorrow, and Maple Tree Logistics Trust, as we just spoke about, out on the 23rd. And a whole slew of results, including iFast, out on the 25th of April. Apart from that, I want to highlight one special event, which is on this Wednesday, on the 23rd of April. We've got a talk by Maybank Asset Management, as well as an external partner on alternative investments, particularly US and Japanese private equity assets. Quite an interesting perspective, particularly now when you look to diversify risk. So do sign up by contacting your salesperson for that. With that, we are out of time. Thank you so much for joining us, and we'll see you next week. Have a profitable trading week.